Good morning, everyone. Good morning, dear students. I, CA Jagvandupadi, welcome you all on behalf of Institute of Chartered Accountants of India to this live session on the subject of advanced financial management. And we are going to start with a very interesting topic, which is advanced capital budgeting. Okay, so I'm pretty sure that all of you have already learned the concept of capital budgeting at your CA inter level. Okay, so you might have already learned this concept at the CA inter level, wherein you might have computed the net present value, the internal rate of return, modified internal rate of return. You might have learned adjusted I can say equivalent or annualized NPV. Then the various principles when we are calculating the NPV for a project, like the cash flows needs to be considered, the profits should not be considered, the cash flows should be after tax, cash flows should be relevant cash flows. So such sort of multiple aspects you might have already learned at your inter level. So in this topic, we are just going to take the discussion further. Okay. And we will be discussing like what all other things needs to be taken into account, or what are the various other practical issues that we may face when we are having this capital budgeting as one of the point of discussion. So practicalities, then some sort of risk that we have in the capital projects. Those things are the ones which we are going to discuss in this particular topic now. We are already aware of the techniques to calculate or to evaluate the feasibility of a project by using NPV, by using IRR, by using payback period, discounted payback period. I'm pretty sure we all are aware of all these aspects, right? Now, in today's session, and also in the subsequent couple of sessions, we'll be discussing about this topic in a different perspective. Now, what all things are we really going to consider when we are calculating the feasibility of a capital project or investment project? Because understand that when we are taking a position in any investment project, if you're taking position in any investment project where we are taking, let's say, investing or committing a big amount of money into it, there's obviously some sort of uncertainty in it. There is some sort of challenges which the project may face while during its course. So whatever the things can happen with the projects, that's what we are going to cover. So let us first set an outline as to what all things we are going to cover in this session. Okay, or what all things are we going to really discuss in this particular topic for today, as well as the couple of sessions in the upcoming days. So the points to be considered, or the outline that we are going to learn, first is impact of inflation. So first thing that we're going to learn is impact of inflation on capital budgeting decisions. So we're looking at what is the impact of inflation on capital budgeting decisions. Okay, so we're looking at what is the impact of inflation on the capital budgeting decisions. Because understand, if you are taking a project which is going to run for years, one of the important aspects which will make your cash flows uncertain is the inflation. So the price levels may rise in the economy, due to which you may face certain situation that the prices of the projects are increasing, right? And or the price of your goods are increasing, the cost is increasing. So in that situation, we are going to have the discussion of impact of inflation on capital budgeting decision. How inflation is going to influence our capital budgeting decisions. Second thing that we are going to discuss in this topic is to look for risk analysis in projects. So we will be carrying out risk analysis, right? So risk analysis in capital projects. Okay, risk analysis in capital projects. Now, any capital project, where the money is invested, okay. So any capital project where the money is invested, the cash flows are going to be some sort of variability, right? Because when you're evaluating the cash flows, when you're evaluating the project, you will definitely have some cash flows in mind. You will be forecasting the cash flows, but remember, you're forecasting, you're not calculating. Ultimately, the cash flows may get affected. Ultimately, the cash flows may get influenced, right? Or it may be subject to some sort of variation. Okay. So we're going to use certain tools for risk analysis in capital projects. So the first thing is we're going to use certain statistical tools. We're going to use certain statistical tools to carry out risk analysis. Now, statistical tools would be looking at the probability of cash flows, then looking at variance of cash flows, then calculating the standard deviation of cash flows, right? And also calculating coefficient of variation. So these numbers are going to be calculated to evaluate the various risks that a capital project may face. Second set of tools that we are going to use while analysis the risk of capital is conventional tools. So conventional techniques, these are like age-old techniques which are used for carrying out the statistical analysis. First is called as risk-adjusted discount rate, calculating the risk-adjusted discount rate. Secondly, we will be also looking at something called as certainty equivalent. Certainty equivalent. So conventional techniques include risk-adjusted discount rate and certainty equivalent. And third case, there are going to be certain other techniques. Now, the other techniques will include sensitivity analysis, right? Carrying out how sensitive the project's variables are with regards to their final NPV. Then we will also carry out something called as scenario analysis, wherein we are going to create multiple scenarios to evaluate the possibilities of the project, what all things may happen with the project. Third, we may carry out decision tree analysis. And also, we may do some sort of simulation. Simulation is basically creating a wide variety of possibilities that the project may come up with. So, of course, on pen paper mode, we may just look at few of the situations, but when you're running it in actual sense in the market, you may actually face a a different situation altogether. Okay, so that's your risk analysis in capital projects. Third is adjusted present value. So this is going to be adjusted present value. Okay, so adjusted present value will be computed to calculate something like, evaluating how the funding for the project is going to be. So initially you evaluate the project assuming that fully it is done with your own funds, and then you look at the possibility of, or the likelihood of you getting some other value when you're using debt. So this is like the outline of the things that we are going to discuss in today as well as the upcoming set of sessions. Okay, now let's just get started with a very important aspect of capital budgeting, which is the first one. That's going to be impact of inflation on capital budgeting decisions. Okay, so let's start with the first one, which is impact of inflation on capital budgeting. Okay, so this is like the impact of inflation on capital budgeting. Now, what's going to be the impact, or how are we going to consider the impact of inflation on capital budgeting? First, for that, we'll have to understand what's inflation is. What do you mean by inflation? What do you understand by the term inflation, everyone? Yeah. What do you mean by inflation? Inflation is what? It is simply increase in the price levels, right? Increase in the price level in the overall economy, right? So inflation is going to lead to increase in the price level. Now, when we are planning for capital budgeting, we need to definitely consider the impact of inflation. So for example, let's say selling price of one unit, or I can say selling price of product is rupees 10 per unit. So let us say that the price of each product that we are setting is going to be 10 rupee per unit, and the project is going to last for, let's say, 4 years. During these 4 years, if we consider the units, let's say in the first year, you're selling 1,000 units. In the second year, you're selling 1,200 units. In the third year, you're selling 1,500. And in the fourth year, you're selling 2,000 units. So now if I ask you, what is the level of sales at the current price levels? Or I can say the value of sales at existing prices. So the sales that we have at existing price, it's pretty easy to compute. What will be the value of sales at existing price? Of course, 1,000 into 10, which is 10,000, 1,200, which is 12,000. Then in the third year, we're going to have it as 15,000. And in the fourth year, it's going to be 20,000. Now, if I give you a situation that, let us say, there's an inflation in the economy, and the inflation rate is, suppose, 5%. Let's say there's inflation in the economy. Now the inflation rate, I'm saying it is 5%. Now, do you mean that the sales values are going to be remaining same? Do you think that the sales value is going to remain same? Are the sales values going to remain same? No. we'll have to first get the revised sale price per unit, right? So we'll have to first get the revised sale price per unit, and based on that, we are going to calculate this. Okay, so inflation is 5%. So we need to have first up the sale price per unit. So sale price per unit is, with inflation of 5%, how much will be the sale price in the first year is? What will be the value of inflation? What will be the value of the product, or what will be the selling price per unit in the first year? If I say that there's an inflation of 5% in the market. So if there's an inflation of 5%, the sale price will be 10 into 1.05, which is 10.5. Second year, the sale price is going to be 10.5 into 1.05, because we are increasing the prices by 5% every year. So that's 10.5 into 1.05. That's essentially 11.03. Then 11.03 into 1.05. Again, the price is increasing by 5% in the third year. So 11.03 into 1.05. That's 11.58. And in the fourth year, your sale price will again increase by 5%. That's going to be 11.58 into 1.05. 11.58 into 1.05, which is 12.16. And so these are your sale prices per unit. Right? So we got the sale price values per unit basis, right? Now, based on these sale prices, based on the sale prices per unit, we can simply calculate the sales at future price levels. So you can simply calculate the sales at future price levels. So if our sale price is 10.5 or 11.03 or 11.58 or 12.16, we can definitely calculate the sales at a future price. And for that, we just need to multiply this with the units. So now the new sales figures at the revised price, which is the price is including the inflation, then it's going to be 10.5 into 1,000, which is 10,500. Then 11.03 into 1,200, which is 13,236. Then we have 11.58 into 1,500, which is 17,370. And finally, you have 2,000 into 12.16, which is 24,320. Okay. So these cash flows that we had, the cash flows that we calculated in this case, these are at existing prices. And existing prices are essentially your real cash flows. These are your real cash flows. Whereas over here, these are said to be your nominal cash flows. So real cash flows and the cash flows, the other side are called as the nominal cash flows. So what do we mean by this? It means the cash flows which have already accounted for inflation. The cash flows which have already accounted for inflation are said to be nominal cash flows. And the cash flows which are calculated at your existing prices without any impact of inflation, those are said to be the real cash flows. Now, the question is, can we discount both these cash flows? Can we discount both these cash flows using the same rate of discounting, or the discounting rate should be different? Are we supposed to be discounting the cash flows at the same rate, or should we be discounting at a different rate? Yes. What should be the discounting rate? Can the discounting rate be same? Can the discounting rate be same for both the type of cash flows, the nominal cash flow, which includes the inflation impact, and the real cash flow, which doesn't include the inflation impact? Can the discounting rate be same? Yeah. Obviously not, sir, because the real cash flows and nominal cash flows are two different types of cash flows. The impact of inflation is considered in nominal cash flow. So, of course, under such situation, we can say there have to be two different discounting rates. Now, understand the discounting rate of return. Here, the real cash flows will be discounted at real rate of return. It should be discounted at real rate of return. And nominal cash flows are going to be discounted at nominal rate of return. Okay, so now my question is, what do you think, guys? What do you think? Real rate of return and nominal rate of return. Which of these two numbers is going to be a higher? Which of these two numbers do you think is going to be higher? Yeah. Which of these two numbers do you think is definitely higher? Of course, your nominal rate of return is going to be higher. Okay, because it includes the impact of inflation. So, of course, it will be somewhat higher than the real rate of return. Okay, so it's going to be somewhat higher than the real rate of return. Okay, now let's try to understand what's the relation between real rate and the nominal rate. Because we said that since the cash flows are higher because of inflation, the nominal rate is going to be definitely higher than the real rate. Okay, then let's talk of what's the relation between real rate and the nominal rate. So we look at relation between real rate and the nominal rate. So relation between real rate and the nominal rate. So let us say we have a real rate of return as 6%. And if we have in the market the inflation is suppose 5%. So real rate of return is, let's say, 6%. Now, how is this real rate determined? The real rate is determined based on the risk of the project. So if the risk of the project is higher, obviously the real rate is also going to be higher, right? So based on the risk of the project, the real rate of return is determined, right? So how is this real rate determined? That we'll discuss at a later point of time. But right now we can just take it as a point that real rate is determined. This depends on the risk of project. Now, apart from you undertaking a risk in the project, you're also going to face inflation. So how do we obtain the nominal rate? Okay. How do we obtain the nominal rate? Let's try to understand this. There's a formula for it, but I'm not giving you the formula directly. There is some thing, some derivation that goes in the background. So let's say we are in year 0 and we're trying to move to year 1. So in year 0, 1 rupee in year 1 should become at a real rate 1 rupee in current situation, at a real rate, that 1 rupee should become 1.06. So at a real rate, 1 rupee should become 1.06. Right? So at a real rate, it should become 1.06. Or I can say, assuming no inflation. So if there is no inflation in the market, you can say rupee 1 today should become 1.06 after 1 year. Okay, rupees 1 should become 1.06 after 1 year. Now, let us say price levels. Price levels that we are going to consider. 1 unit, as I said, should become 1 rupee should become 1.06. Now, if there is inflation, if inflation at the rate of 5%, if inflation at the rate of 5%, so let's say 1 unit of product, if it is 1 rupee, after accounting for inflation, after a year, after accounting for inflation, after a year, this same 1 unit should be equal to what price? If inflation is considered, then after 1 year, with the inflation rate of 5%, what is the value of 1 rupee going to be? I mean, 1 unit will be costing us how much? Price of 1 unit will be, can I say 1.05? Right? Or let me put it other way around. Let's say 1 unit is 1 paise. 1 unit is 1 paise. So in this situation, 1 rupee is going to be how many units? If 1 unit of the product, 1 unit is costing us 1 paise. So how much is this 1 rupee going to provide us with? How many units? Can I say 100 units? Now, due to inflation, if 1 unit is equal to, that let's say that it increases to 1.05 paise. If 1 unit, due to inflation, the price increases, and now the price of the new product, price of the product is 1.06 paise, 1.05 paise, because it's 5% inflation. Right? So with 5% inflation, we can get the price as 1.05. So after 1 year, our money has grown to 1.06. So 1.06 is equal to how many units, guys? Because 1 rupee which I have invested, that's going to grow at 1.06, right? Today, if we would have spent that money, we would have got 100 units. And we have invested it at 6%, right? So at a real rate of 6%, we invested it, and that 1 rupee became 1.06. So today, you were getting 100 units for consumption. When the money has increased and there is also inflation in the market, 1.06 rupee is going to provide you with how many units, guys? If one unit is 1.05 paise, so with the available money of 1.06 rupee, how many units are we really going to get? How many units are we really going to get? That's 1.06 divided by 1.05. Or I can say 1.06. 1.06 divided by, we have 1.05 paise, so 0.0105. That's going to be 100.95 units. So now the point over here is, guys, your 1 rupee has increased to 1.06 with the real rate. But as far as inflation is considered, the units that you are going to consume, today it was 100 units. After a year, it is just 100.95 units. It means units have not actually increased by 6%. The units are still increasing at the same, they are increasing at somewhat lower level, right? So due to inflation, units that can be purchased is now 100.95, which is definitely lower than your target, right? So can we say that if you are just getting the real rate of return and there is inflation in the market, the units consumption doesn't increase to that extent, right? So after considering the inflation, right? So let's say if I want the consumption, if I want this 100 units to be 106 units, if I want this 100 units to become 106 units, if I want this 100 units to become 106 units, can you tell me what should be the value of investment? So what should be the value of our investment in year one? Because if it is turning out to be 1.06, if 1 rupee is becoming 1.06 and there's an inflation of 5% in the market, then we are seeing we are just getting 100.95 units. So for 106 units, what should be the value of investment? Of course, for 106 units, the value of our investment should be 1.05 paise per unit. 1.05 paise per unit into 106 units divided by 100 to make it rupee. So this should be 1.05 paise per unit. And we want 106 units divided by 100. So value of our investment should be 1.113. Or I can say, considering inflation, to get a real rate of 6%, considering inflation, to get a real rate of, considering inflation, to get a real rate of inflation, or you can say real rate of 6%, rupee 1 should become rupee 1.113. Because with this 1 rupee, you can get 100 units. And with this 1.113, you can get 106 units. So to get that real rate of return, in real terms, the unit should increase. Sir. In real terms, your units which you are consuming 100 units, that should become 106 units. So to make that 106 units, your price or the value of 1 rupee should become 1.113. Right? So this simply means, what is the rate of return considering inflation? Rate of return considering inflation? Well, the rate of return considering inflation, as I said, it will be 1.113 minus 1 divided by 1, which is 11.3%. Is 11.3%. Okay. So if you are getting a return of 11.3%, so which means 1 rupee becomes 1.113. Then when you convert it in terms of units of consumption, you will see that there is a real increase in the units of increase in the real units, that is going to be from 100 to 106 units. Okay, so that's how we get this nominal return. So let me just formalize it. Well, the formula is 1 plus real rate of return, 1 plus real rate of return multiplied by 1 plus inflation should be equal to 1 plus nominal rate. Like in our situation, we wanted the inflation to be 6%, right? So we wanted the real rate to be 6%, and inflation was 5%, so 1.05. That gives us 1 plus the nominal rate. So this is 1.113. That's equal to 1 plus nominal rate. And finally, the nominal rate will be 11.3%. Okay. So understand this simple concept, guys, that when we are looking at inflation, I need to get the rate of return, which will provide me not only the inflation, but also the real rate of return. So I so that 1 rupee becomes 1.06. 1 rupee becomes 1.06 after a year if there is no inflation. If there is inflation in the market, then we see that 1 unit, if it is priced at 1 paise, that 1 rupee is going to get translated to 100 units. 1 rupee is going to get translated to 100 rupees. And for that 100 rupee, 1 rupee gets translated to 100 units. And if there's inflation, the same 1 paise becomes 1.05 paise. Now, if it becomes 1.05 paise for the real return or for the value which has become 1.06, you can get 100.95 units, which is essentially not providing you with the required return of 6% in real terms. So in real terms, when it is 6%, the unit should increase by 6%. So if I want the units to increase by 6%, we said it should become 106 units. And the value of investment in year 1 will be simply 1.05 paise into 106 units divided by 100. So 1.05 paise into 106 units divided by 100, that gives us 1.113 as the value. So 1 rupee, when it becomes rupees 1.113, 1 rupee when it becomes rupees 1.113, then you are able to get 106 units. And the simple way of calculating the real inflation and nominal rate relation is this. Okay. So let us say I give you certain number and just try to calculate the point that we are talking of. Let's say the nominal return is 13% and inflation is 4%. Can you calculate the real rate of return, guys? Yeah. Try to calculate the real rate of return. Simply use this formula. You can simply use this particular formula. 1 plus real rate into 1 plus inflation rate should be equal to 1 plus nominal. Yeah. Can you calculate the real rate of return? Just use this formula and get the real rate of return, everyone. Get the real rate of return. Yes, get the real rate of return, right? Calculate the real rate of return. So we can say 1 plus real rate into 1 plus inflation, which is 4%, is equal to 1 plus nominal rate, which is 13%. Okay. So we have 1 plus real rate into 1.04 as 1.13. So 1 plus real rate is going to be equal to 1.13 divided by 1.04. So 1.13 divided by 1.04, that's 1.0865. So the real rate of return will be 1.0865 minus 1. So you can say real rate of return is 8.65%. Real rate of return is 8.65%. Okay, that's your real rate of return, guys, 8.65%. So the simple rule is set that when you want to calculate the inflation, when you want to adjust the inflation with the real rate and get the nominal return, we can simply use this particular formula. 1 plus real rate into 1 plus inflation rate should be equal to 1 plus nominal rate. Right? So that's the very simple aspect to it. Now let's try to analyze, let's try to implement this thing using an example. Okay, so let's look at this particular question for our discussion. See, we have to determine NPV of the project. We have to determine NPV of the project with the information. Initial outlay of the project is 40,000. So initial investment is 40,000. Annual revenues without inflation, it is 30,000. And annual cost, excluding depreciation, without inflation is 10,000. Useful life is 4 years. Salvage value is nil. Tax rate is 50%. Cost of capital, including inflation premium of 10%, is 12%. So now tell me, what is this 12%? Is it a nominal rate of return or is it a real rate of return? Is it a nominal rate of return or is it a real rate of return? Is it nominal rate or is it real rate? Yeah. Nominal rate, right? This is the nominal rate because 12%, which is there's an including inflation. So when we're talking of including inflation, that is essentially what we say as a nominal rate. And the cash flows that we have given, cash flows that have been provided to us, the cash flows that has been that have been provided to us, what is it? Is it using, I mean, are the cash flows real or nominal? Are the cash flows real or nominal? So we have the cash flows as the real cash flows, right? The cash flows are real cash flows, correct? Correct. So we got the real cash flows. Now let's do one thing. We'll solve this using both methods. First, by considering the impact of, discounting the cash flows at real rate and also discounting the cash flows at nominal rate. Okay. So we are going to calculate the cash flows using the real rate as well as the nominal rate. So let's first calculate the NPV using real rate of return. Okay. So calculation of NPV using real rate of return. So we are calculating the NPV using the real rate of return. So for that, we'll have to first calculate the real rate of return. So we have the formula of 1 plus real rate into 1 plus inflation is equal to 1 plus nominal rate. Okay. So now we have been given the nominal rate to us. So you can say 1 plus real rate is what we need to compute. 1 plus inflation rate. Inflation is given as 10% and nominal rate is 12%. So we have this as 1 plus real rate into 1.1 is equal to 1.12. Okay. So try to calculate the real rate of return risk. Try to calculate the real rate of return. Solve this and get the real rate of return is. Give me the value of real rate of return. What's the real rate of return? So we know 1 plus real rate will be 1.12 divided by 1.1, which is 1.0182. And then we have the real rate as 1.82%. Real rate as 1.82%. Right? Or let me just make it up to a larger decimal. It should be 1.8182%. So we got the real rate of return as 1.8182%. Okay. Now let us compute the cash flow after tax at real cash flow levels, right? So annual cash flows at current price levels. Annual cash flows at current price levels. So annual cash flows at current price level, we start with revenue. So the revenue that is expected is without inflation is 30,000. Less cost. So the cost is annual cost excluding depreciation without inflation. Less cost, we have this as 10,000. Less depreciation. So depreciation, annual cost, annual cost excluding depreciation. So we need to obviously subtract the depreciation first. So depreciation will be 40,000 being the initial outlay of project for 4 years. So every year it's going to be 10,000. Okay. So we get profit before tax, which amounts to 10,000. Profit before tax is 10,000. And then we have the profit before tax. After the profit before tax, we subtract the tax less tax of 5,000. Okay. So we take the profit after tax as 5,000. Adding back the depreciation, gives us the cash flow after tax. So cash flow after tax is how much? 15,000. Cash flow after tax per annum, it works out to be 15,000 after accounting for the depreciation adding back. Now we can, of course, calculate the NPV of a project using real rate of return. So for that, we'll take the year cash flows and present value factor at 1.8182%. And then we calculate the PV. Okay. So starting from year 0, 1, 2, 3, 4. Initial year, you have 40,000 cash outflow. First year, you have 15,000 inflow. Second year, you have 15,000 inflow. Third year again, 15,000. Fourth year again, 15,000. So just calculate the PV factors and get the present value, everyone. Calculate the present value factor and get the present value or get the net present value for this. Give me the NPV, guys. Give me the NPV value. Yeah, give me the NPV, net present value is. Give me the net present value. So PV factor will be 1, 0.9821. You can take this as 0.9646, 0.9474, 0.9305. Just multiply with the cash flows and take the total for NPV. Yep. So this is minus 40,000. Then this is 17,000, not 17, not. This is what? 14,732. Then the next cash flow is 14,469. It is 14,210. This is 13,957. So adding them all, it comes out 17,369, 368, 17,368, or some rounding up here and there, that's okay. So we saw that how do we calculate the NPV? By discounting the real cash flows with the real rate of it. Now let's give a different perspective to this, wherein we are going to calculate the nominal cash flows. Okay, we're going to calculate the nominal cash flows. Essentially, nominal cash flows means we are simply trying to get the inflation adjusted values. Okay. So after adjusting for inflation, we are going to consider the NPV calculation. So let us calculate the NPV using nominal rate of return now. Calculation of NPV using nominal rate now, or nominal cash flows. Okay. So we already have the nominal rate, so there's no need to think for even calculating the nominal rate. We already have the nominal rate of return with us. But what we want is to calculate the nominal cash flows. So nominal cash flows can be obviously computed after accounting for inflation. Okay. So let's try to understand it in this way. So we have 4 years, year 1, year 2, year 3, and year 4. So the units, I mean, the price at revenue at current level, it is 30,000, right? So revenue, I mean, what's the inflation rate given to us? Inflation is 10%, right? The inflation is 10%. And we have the numbers at current year level. So revenue is going to be 30,000 at current price levels. So what will be the revenue in the upcoming 4 years? What will be the revenue in the upcoming 4 years? After accounting for inflation, revenue should be, 30,000 into 1.1, which is 33,000. Second year revenue will be 33,000 into 1.1, which is 36,300. Then 36,300 multiplied by 1.1, revenue becomes 39,930, and again growing by inflation, this becomes 43,923. That's your revenue. From revenue, you're going to subtract cost. Okay. So at current price level, the cost is 10,000. Of course, since the inflation is 10%, we are going to increase the cost also by 10% every year. So that's 11,000. 11,000 into 1.1. that is 12,100. This into further 1.1, which is 13,310. Further into 1.1, which is 14,641. So cost values are 10,000, 11,000, 12,100, 13,310, and 14,641. That's your cost. Then further, we are going to subtract the depreciation. Now, here is something interesting. The depreciation part, which we are going to compute, is something interesting. Is depreciation value getting affected by inflation, guys? Is the depreciation going to increase with the rate of inflation? No. So when you're calculating depreciation, remember there's not going to be any impact of inflation into it. Okay. So whatever is the amount of depreciation which you have computed in the year 0, that is going to continue same. So this is depreciation of 10,000 and will remain intact. It's not going to have any change. Then you have from revenue, these costs are subtracted, and you have profit before tax. Okay. So profit before tax, of course, let's just compute it from year 1 onwards. Profit before tax will be 33,000 minus 11,000 minus 10,000. So this is 12,000. Profit before tax is 12,000. 36,300 minus 12,100. Further subtracting 10,000. 36,300 minus 12,100 minus 10,000 gives us 14,200. Then 39,930 minus 13,310 minus 10,000. This is 16,620. And then we have 43,923 minus 14,641 minus further 10,000. That gives us 19,282. Right? So these are the profit before tax figures. Okay, 19,282. That's your profit before tax figure. Now, once we have got the profit before tax figure, then we are going to subtract tax. Okay, that's going to you're going to subtract tax. And after subtracting tax, you will get profit after tax. You add back the depreciation to arrive at cash flow after tax. Okay, so just carry out these calculations and give me the cash flow after tax numbers, guys. Give me the cash flow after tax numbers. Give me the cash flow after tax. Yeah. So cash flow after tax, it is 16,000. Okay. 17,100 18,310 and 19,641. Yes. You get is 12,000 as the PBT into 50%, which is 6,000. On that 6,000, we add back the depreciation of 10,000. Okay. 14,217. Okay. Then this is 19,282. Yeah. So these are the cash flow after tax. Now, of course, we can calculate the NPV using the nominal rate. So we'll simply write down year cash flows, PV factor at the rate of 10%, and then you take the PV. So here 0, 1, 2, 3, 4. We have initial investment of 40,000 being made. Then you have 16,000, 17,100, 18,310, 19,641. Just multiply it with the PV factors and get the NPV. Nominal rate is how much? Oh, 12%. Okay. So the nominal rate is 12%. We have to get the PV factors at 12% then. Yeah. At the nominal rate of 12%, get the PV factors multiplied with the cash flow, and then take the total. And then tell me what is the NPV using nominal rate. What's the NPV? Calculate and give me, guys. What's the NPV? Okay. So NPV is what? 13,433. Okay, we got it NPV as 13,433. Perfect, guys. Now, one thing that we have come up over here, that when we are looking for impact of inflation, the impact is definitely on the revenue and cost, but on depreciation, there is no impact. Okay. So we need to be remembering that inflation is not going to have any impact on depreciation, right? So just to add an important part over here, we know that cash flow after tax is computed as revenue minus cost minus depreciation. We make it as after tax by making it as 1 minus T, and then we add back depreciation. So we take revenue minus cost minus depreciation into 1 minus T, which is after tax thing, and then plus adding back the depreciation. So this is going to be revenue minus cost, let's say into 1 minus T, minus depreciation into 1 minus T, plus depreciation. So this revenue minus cost into 1 minus T minus depreciation plus depreciation into tax plus depreciation. We're just opening it up. So D into 1 and this minus D into minus T, that becomes plus DT and A plus T. So now, of course, from here, your minus D and D gets cancelled. And what we have is revenue minus cost into 1 minus T plus depreciation into tax rate. Now, remember, this particular portion is impacted by inflation. This is getting affected or this is getting impacted by inflation. This one is having no impact of inflation. So there is no impact of inflation, as depreciation is based on historical cost. So revenue minus cost into 1 minus T, that is something which is impacted by inflation. And then you have depreciation into tax, D into T. That's a situation where no impact of inflation. So we can also calculate CFAT by changing these items with inflation and keeping this constant and then adding it back. Okay. So that's your CFAT calculation or cash flow after tax calculation. Let's do one thing. Let's take another question where there is an impact of inflation. That's question number 2, guys. So let's do one thing. See, second question. We require 8 lakh for an unit. So for building up a new factory or a new unit, we need 8 lakh rupee. Useful life of the project is 4 years. Salvage value is nil. Depreciation charge is 2 lakh per annum. Expected revenue and cost, excluding depreciation, ignoring the inflation, we have the revenue as 6 lakh, 7 lakh, 8 lakh, 8 lakh. And these are the costs that we have. So tax rate is 60% cost of capital and 10% is the cost of capital. Tax rate is 60%. Cost of capital is 10%, including the inflation premium. So they haven't given any inflation as such for no wholesome figure, but they have inflation for each items. So for revenue and cost, there is a separate set of inflation. Now, can we really calculate this? Because expected, they're saying ignoring inflation. So what are these revenue and costs? What are these revenues and costs? Are they real cash flows or are they real revenues or are they nominal revenues? They are real cash flows, right? They are definitely real cash flows. So we have the cost of capital given to us as 10%. And in this, they're saying it includes inflation premium. So what is this 10%? Real rate or nominal rate? Real rate or nominal rate? What is this 10%? Is it real rate or is it nominal rate? Is it real rate or nominal rate? 10%. Because they're saying 10% including inflation premium. Of course, it is nominal rate. Okay. So we have the cash flows as real cash flows. Discount rate is given as nominal rate. So which method should we adopt over here? Should we discount the real cash flows using real rate of return? Should we discount the real cash flows using real rate of return? Should we discount the real cash flows using real rate of return? Or should we discount the nominal cash flows using nominal rate of return? There are two approaches, as we said. Discount the real cash flows using real rate of return, or discount the nominal cash flows using nominal rate of return. So which one do you feel, or which one do you think is going to be acceptable over here? Cash flows are real, rate is given as nominal. Real rate, in this case, we can't calculate this because there is not a general inflation rate which is given to us. So we don't have a general inflation rate given to us, right? So there's no general inflation rate provided to us. And as the general inflation rate is not given to us, as we don't have a general inflation rate, we can't calculate the real rate, right? And therefore, I'll have to calculate all the cash flows over here using nominal rate only. Okay, so let us simply compute the nominal cash flows, right? So we'll have it as year 1, year 2, year 3, and year 4. Okay, so we have the revenue and costs at real levels. So let us calculate, or let's first write down a real revenue. So real revenue is 6 lakh, 7 lakh, 8 lakh, 8 lakh. And we have the inflation rate given to us. Inflation is 10%, 9%, 8%, 7%. So we have the real revenue and inflation rate given to us. So real revenue is 6 lakh, 7 lakh, 8 lakh, 8 lakh, 10, 9, 8, and 7. So first let us get the nominal revenue. Let's get the nominal revenue. Nominal revenue will be 6 lakh into 1.1, which is 6 lakh 60,000. In the second year, the nominal revenue will be 7 lakh into 1.1. 7 lakh multiplied by 1.1, 1.09. Yeah. So 7 lakh into 1.1 into 1.09. This is 8 lakh 39, 300. Then third year, 8 lakh is the real revenue, but I need to get the inflation adjusted for it. So this is into 1.1 for the first year, 1.09 for the second year, and for the third year, it's going to be 1.08. So what's the nominal revenue in this case? It is 10 lakh 35,000 936. And finally, in the fourth year, we have the nominal revenue as 8 lakh into 1.1, 1.09, 1.08, 1.07. So just multiply it and get the nominal revenue over here, which is 11 lakh 8,452. 11 lakh 8,452. That's your nominal revenue. Then let us consider the real costs. Real costs are given to us as 3 lakh, 4 lakh, 3 lakh. Then you have 4 lakh, again 4 lakh. Finally, we have again last year also 4 lakh. But the inflation rates are given to us. The inflation rates are 12%, 10%, 9%, and 8%. So just give me the nominal costs, guys. Give me the nominal costs. I've given you the idea how to get the nominal revenue. Similarly, get the nominal cost values. Get the nominal cost values. Yeah, so nominal costs are 3,36,000. Okay, 4,92,800, 5,37,152, and 5,80,124. Okay, so these are the real revenue, sorry, nominal revenue, nominal costs. Now we can definitely say the amount of depreciation. We can subtract the depreciation figures. Now, what's the depreciation? Amount of depreciation. How much will be the amount of depreciation? Well, depreciation is like what, 8 lakh for that cost, and we are having 4 years. So every year there's going to be a depreciation of 2 lakh. So we have the depreciation as 2 lakh. That gives us profit before tax, where your nominal revenue is A, nominal cost is B, and depreciation is C. So that's simply A plus A minus B minus C. So what are the PBT figures? Profit before tax figures. Give me the profit before tax figures, everyone. Give me the profit before tax figures. Because from that, we will subtract the tax, which will give us profit after tax. And the tax is what? At 60%. We'll add back depreciation. And then we'll say, what is the value of CFAT? Add back depreciation. And then we just take it as CFAT. Yeah, so CFAT, what are the CFAT figures? Cash flow after tax. So this is what, 2,49,600, 2,58,600, 3,19,514, and 3,31,331. Okay, so we've got the CFAT. Now you just need to multiply by with the present value factor at 10%, get the PV, and finally we'll have the NPV. So present value factors 0.9091, 0.8264, 0.7513, and 0.6830. So CFAT multiplied by the present value factor will give you the PV, and then adding them all together, subtracting from the cost, which will give you the NPV. So present values are 2,26,909, 2,13,719. Then this is 2,40,055, 2,26,304. Just add them all and then subtract 8 lakh, which is the cost. So total of all of them is what? 9,06,987 minus 8 lakh. That gives us the NPV number 9,06,987 minus 8 lakh, which is 1,06,987. So the NPV is positive, so we should be definitely going ahead with the project. Okay, fine. So with that, we have completed the inflation adjusted NPV in this case. Let's take a break now, and then after the break, we will be taking the discussion to the next point, which is understanding the risk analysis or carrying out risk analysis in capital budget. Okay, so let's just take a break right now, guys. See you after the break of 10 minutes. Okay, let's take a break, guys. Okay, welcome back, guys. I hope we all are back after the break. We have completed uh, the discussion on impact of inflation. Okay, so inflation, as we said, we followed the simple rule: discounting the real cash flows with the real rate of return and discounting the nominal cash flows with the nominal rate of return. Okay. Now, with these things into consideration, let's discuss about the next aspect, which is the risk analysis in capital budgeting. So, risk analysis in capital budgeting involves uh, looking for impact of probability, okay, and the possible situations that may arise in future, and how do we account for those changes that are likely to happen. Okay, so let's try to understand how do we go about calculating or measuring the risk based on some probability. Okay, so for that, let's first understand the possibility or the way of obtaining the expected value, standard deviation, variance and coefficient of variation, and all such aspects. Okay. So before that, before we go directly into understanding or applying this into the questions, let's first recap those things. Okay. Regarding the probability and the way to calculate the returns, calculate the expected value and variance. Okay. So we're going to discuss few things over here. First is regarding the expected rate of return, I mean expected value. So we're going to discuss expected value. Then after that, we're going to discuss the standard deviation. Okay. And then coefficient of variation. Okay. So let's try to understand all three of them with an example. Let us say we are having multiple scenarios for the upcoming year. One of the situation could be you are having a strong optimism. So you have like strong optimistic. The strong optimistic, or you're having some level of optimism, but which is a bit low, which is, let's say, weak optimistic. Then we can think of a moderate situation. Then you're having pessimism, but not to that great level. So we'll say we are having a weak pessimistic approach. Okay. And then you have the strong pessimistic approach. So strong optimistic, weak optimistic, moderate, weak pessimistic, and then strong pessimistic. Okay. Let us say each of these situations have got certain probability. So the probability is like strong optimistic is having a probability of 0.5. Weak optimistic is having a probability of 0.2. Moderate is having optimistic of, I mean, probability of 0.1. Weak pessimistic has got, let's say, a probability of 0.15, and strong pessimism is giving us a probability of 0.05. Okay, so let us say the returns that we are expecting, or uh, the NPV that is expected. Okay, so let's say net present value, if everything is perfect, if everything seems to be good and there's no problem upcoming and everything is working in our favor, then the NPV is going to be, let's say, 500. If it's optimistic scenario, weak optimistic, then the NPV is going to be, let's say, 400. Then let's say it could be 350 or 300 or 250. So these are our NPV figures. So probability is given and your NPV figures are given. Okay. So now with these probability and NPV figures, I want to know, we know that the range of our NPV, net present value of the project, can range from, let's say, 250 to 500. But I want to know how much should I expect? What should be the expected NPV in our case? So what should be the expected NPV? So for the expected NPV calculation, the formula is simple. When we calculate expected NPV, expected NPV will be summation of probability into NPV. Summation of probability into NPV. So which is simply going to be like you multiply probability with NPV. So you multiply probability with NPV. So P into NPV. So you can take probability into NPV and then take the total. So probability into NPV. Let's just multiply it and take the total. So just do it this, multiply the probability, because each of these NPVs are having these probabilities. So if I'm asking for what is the NPV that I should expect, you should obviously multiply this with the probability and take the total. So give me the total of this. Give me the total of probability into NPV. Yeah. Yeah, how much it is? 422.5. Okay, perfect. So expected NPV is 422.5. Okay. But listen, this 422.5, the NPV which you are expecting, it is definitely this expected NPV. This is not certain. This is subject to some sort of variation, right? So this is subject to some sort of variation. Now, what variations are we really looking at when we are talking of expected NPV? What sort of variations are we going to talk of? So let's talk of calculating the standard deviation. So let's first get the value of deviation for us. Let's first get the value of deviation. So if I ask you, what is the deviation? So deviation is simply looking for difference between NPV and expected NPV, or expected NPV. We generally call it as, NPV bar, or even expected NPV, NPV bar, or even expected NPV. So we take the NPV minus expected NPV. That is basically, this is representing the deviation from mean, right? Because as we said, this particular 422.5 is not something which is certain. It is subject to some sort of deviation. Okay, it is subject to some sort of deviation. So if it is some sort of deviation from mean, we are obviously saying let's calculate the NPV minus expected deviation. Okay. Now, of course, if you just multiply, I mean, this particular deviation, uh, certain numbers will be positive, certain numbers will be negative. So they'll be nullifying each other. So to avoid that, what we do is we simply take this NPV minus the expected NPV. Okay. And then multiply it with probability by taking the square. The whole idea of taking square is, since your NPV and expected NPV are going to be subtract, you will have certain values which are negative, certain values which are positive. Now, that doesn't mean that there are, they will nullify each other. That doesn't mean there is no deviation or there is lower deviation. So to improve that, what we do is we're just going to take a square of it. Okay. So we're just going to take a square of it and then multiply it by P and then take the total. So give me this total. This total will be used for computing the standard deviation. Give me the total, guys. What's the total? Probability into NPV minus expected NPV. The square of it. So remember, first you'll have to take the square of this and then multiply it by the present value. So for example, NPV minus expected NPV, 500 minus 422.5. So the first value that we are going to have is that's 500 minus 422.5. This will be 38.75. Sorry, not 38. My bad. That will be 77.5. Yes. This is 77.5. This is minus 22.5. Then we have minus 72.5, minus 122.5, minus 172.5. These are NPV minus the expected NPV. Okay, then we just multiply probability with this deviation. So probability with deviation square. So first we need to do the square of this. So take a square of 77.5. Okay, and then multiply it with probability. So this should be 77.5 square. And then multiply it by 0.5. So the first value is 77.5 into 77.5. That's 6006.25. Multiply it by 0.5. Yeah, so this is 3003.125. Second is 101.25. Third one is 525.63. Fourth it is 2250.94. And then we have 1487.81. Okay, so these are the probability multiplied by the deviation square. So probability multiplied by deviation square. Just take a total of it. Yeah, given the total 7368.75. Okay, 7368.75. So this is the summation of probability into NPV minus expected NPV square. Okay. So this is essentially probability into, this is what we are getting it as 7368.75. Okay, so this is 7368.75. This particular number is called as variance. Okay, so variance is essentially deviation square. It is summation of deviation square. Now, of course, since it was squared, I need to bring it back to the original level. Now, to bring it back to the original level, we are going to calculate standard deviation. And the standard deviation formula is square root of variance. Standard deviation formula is square root of variance. So standard deviation okay. So it's going to be square root of 7368.75. So give me the square root of 7368.75. How much is it? 7368.75. How much is it? Square root of this? This is 84, right? So standard deviation of X is 85.84. Okay. Then what do we interpret this 85.84? Well, the interpretation is pretty simple, guys. Interpretation is that you will be able to get the NPV as 422.5, but there will be plus 84. So your NPV is likely to be additional 84.84, or it could be even lower by 85.84 in the outcome. So we are simply deciding a range of NPV. Okay, so we are deciding the range of NPV, wherein we say the NPV can be 85.84 above 422.5, or it, okay, with obviously some certain degree of probability. You can say with 99% surety, we can say that the NPV can be additionally 85.84 or lower by 85.84. So these are the two uh, limits or the levels we are setting, a higher level and a lower level. Okay, that's your way of calculating the standard deviation. Now let us look for calculating something called as coefficient of variation, because every project is going to have different value of expected NPV and standard deviation. So we may not be in a position to compare the projects. So just by looking at NPV or just by looking at standard deviation, we can't compare or get the idea of the risk of a project. So for comparison purpose, we are going to get the coefficient of variation in the percentage form, so that the variation or the risk of a project can be compared with other project. So we calculate something called as coefficient of variation. So coefficient of variation. So coefficient of variation will be simply standard deviation divided by expected NPV. Okay, so coefficient of variation, we have the standard deviation as 85.84 upon expected NPV is 422.5. So we are essentially looking at how much portion of our NPV, how much portion of our NPV is subject to deviation. How much portion of our NPV is subject to deviation, right? Or how much of it is subject to fluctuation. So 84.84 divided by 422.5, that gives us 0.2032. 0.2032, or we can simply say it's 20.32%, right? So 20.32% of the expected NPV is subject to fluctuation. Higher this number indicates a greater degree of risk in it. And of course, lower the number, lower is the risk inside it. Okay. Now let us go for applying this standard deviation and expected value as well as the coefficient of variation on the practical questions we have. So let us look at question number 3. So look at this question number 3 now. Possible net cash flows of projects A and B at the end of first year and their probabilities are given below. So we have 5 possible events. Project A with the cash flows, 5 different cash flows with a respective probability, and same is for project B. Their probabilities are given below. Discount rate is 10%. Okay. So discount rate is provided us to be 10%. We have the initial investment to be made as 10,000. Calculate the expected NPV of each project. State which project is preferable. Okay. So we have to get the preference for each of the projects. So we are saying that end of first year and their probability. So these are like the projects which are having a life of just 1 year, right? Projects with just a life of 1 year. So within 1 year, the project is going to be wound up, and we have to compute the project. We have to compute the for both projects, calculate the expected NPV, and also say which project is going to be preferable. So of course, expected NPV means we have to get the expected value of the cash flows initially, right? So we'll have to get the expected cash flow. And then, of course, we can get the expected NPV also, okay? So remember one rule, that whenever the question says you want to calculate the expected cash flow or variance of cash flows, expected cash flow or variance of cash flow, or if the question says what is standard deviation of cash flows, okay, expected cash flow or variance of cash flow or standard deviation of cash flow. Remember, this is going to be calculated use cash flows and probabilities. Okay. Same way, if we want to calculate expected NPV, or you want to calculate, let's say, variance of NPVs, expected NPVs or variance of NPV or standard deviation of NPV. So in either of this situation, we are going to use NPV and its probabilities. Okay. So in this situation, we have the cash flows and the probability. So we'll have to first get the expected cash flow of project A in year one. So for project A, we have the probabilities given to us, probabilities and cash flows. We can definitely do probability multiplied by cash flows. So probabilities are 0.1, 0.2, 0.4, 0.2, and 0.1. And the cash flows are 8,000, 10,000, 12,000, 14,000, and 16,000. Probability multiplied by cash flows is going to be simply 800. Then this is 2,000, 4,800. Then we have 2,800 and 1,600. So the total is 12,000. So this is the expected cash flow. Expected cash flow in year one is 12,000. Okay, so expected cash flow in year one is 12,000. So project A is having an expected cash flow of 12,000. Okay. Now, with this expected cash flow, I can calculate the expected NPV also. So what will be the expected NPV? That will be just expected cash flow in year one multiplied by the present value factor minus initial investment of 10,000. So this is simply 12,000 into present value factor. Discount rate is given as discount rate is 10%. So it's just going to be 0.9091. Right? So discount factor is 0.9091. And you just subtract 10,000 out of it. So this comes out to be what? 12,000 into 0.9091 minus 10,000, which is 909.2. That's your expected NPV of project A. Same way, we can get the expected NPV for project B also. It's on the similar lines. So expected NPV for project B. I'll just give you a couple of minutes, guys. Try to calculate this project B expected NPV. Calculate the project B expected NPV quickly, guys. Same method, it's just the cash flows are different. Just the cash flows are different. Yep. What's the NPV of project B? Expected NPV. Use the same technique. You just have to take the probability, multiply it with cash flow, and then take the total and then just apply the NPV calculation. That's it. Yeah. Project B expected NPV. Project B expected NPV is going to be how much? 4544. Okay, perfect. So we have two NPVs now. Project A is having an expected NPV of 909.2. Project B is having an expected NPV of 4544. So out of these two, which project should be accepted, guys? Which project should be accepted? Of course, it's project B, which is having a higher value, which is having the higher NPV. The project with higher NPV will be definitely accepted, right? So pretty simple. Now let's go for, yeah, question number 4. So in question 4, it is a bit different question in which you have year 1, year 2, year 3, and the cash flows are having a different degree of probabilities. So we have got the cash flows with probabilities. Okay, so we have cash flows with their respective probabilities given to us. We have to compute the expected NPV of the project using 10% discount rate if the initial investment of project is 10,000. Okay, so if the expected NPV of the project is 10,000, we have to get the present value has to be computed in 10%, but then the project initial cost is given 10,000. Now I can get the NPV for this once I have computed the expected cash flows for each of the years. So we need to calculate the expected cash flow for year 1, year 2, year 3. Okay. So let's say we have got year 1, year 2, and year 3. So there are 3 years of operations of the project, right? So for each of these 3 years, we need to compute the NPV. So we'll just write down probability, cash flows, and then probability into cash flows. So for first year, the probabilities are 0.1, 0.2, 0.3, 0.4. Cash flows are 2,000, 4,000, 6,000, and 8,000. So the expected cash flows is simply probability into cash flow. So 2,000 into 0.1, this is 200. 4,000 into 0.2, which is 800. Then 6,000 into 0.3, 1,800. And 8,000 into 0.4, that's 3,200. So just take a total. This is 6,000. Okay. Same way, do it for second year where you have the probability and cash flows, and you just take the probability into cash flows total. Same way, carry out for year 3 with probability, cash flows, and probability multiplied by cash flows to get the expected cash flows. Give me the expected cash flows for these years, guys. Give me the expected cash flows for this. Give me the expected cash flows for year 2 and year 3, guys. Yeah, what's the year two? Year two it is 4,800. Okay. And for year three it is 4,200. Okay. Now, once we have these expected cash flows, now we can definitely think of getting uh, the NPV. So we'll simply go for calculation of expected NPV. Since we have cash flows for all the years, I can get the expected NPV. So we have here expected cash flows. Then we take the present value factor and then the present value. Okay. So year 0, 1, 2, 3. Expected cash flows. Initial year, there's an investment of 10,000. Then in the first year, the expected cash flow is 6,000 positive, 4,800 positive, 4,200 negative. PV factors, you have to get it at 10% and simply arrive at the PV. Yeah, what's the expected NPV, guys? Expected NPV. Take the PV factors and calculate it. How much is it? 2,576.78. Okay, great. So that's the solution to question number 4. Pretty easy. Okay, that's question number 4. Now let us go for the next question, which involves the same sort of calculations, but a bit different thing over here now. See, so question 5, we have got 2 projects. Their cash flows are given and probabilities are given. So you have to calculate the variance and standard deviation of project A and B on the basis of following information. So we just have to get the variance and standard deviation. So cash flows are given to us, probabilities are given to us. We just have to get the variance and standard deviation. So of course, we know to calculate the variance or standard deviation, we are very well aware that we need to get the value of expected value or expected cash flow, and then only we can actually calculate the standard deviation and everything. So let's try to get this for project A. So this is question number 5. So we have like probability and cash flows. So probability are 0.1, 0.2, 0.4, 0.2, 0.1. Cash flows are 8,000, 12,000, 14,000. Sorry, 8, 10,000. 8,000, then you have 10,000, 12,000, 14,000, and 16,000. So we have the probability, we have the cash flows with us. Now we can definitely talk of calculating the expected cash flows. Expected cash flow will be probability into cash flow. right? That will give us the expected cash flow. So let's multiply them and get the expected cash flows, which is 0.1 into 8,000, which is of course 800. Then this is 2,000. The third expected cash flow is 4,800. Then we have 2,800 and 1,600. So just add them all, 800 plus 2,000 plus 4,800 plus 2,800 plus 1,600. So totaling up to 12,000. So probability into cash flow total is 12,000. Okay. So expected cash flow is 12,000. We need to get the deviation, which is cash flow minus expected cash flow. First we take that and then simply multiply this probability into cash flow minus expected cash flow square. Okay, so cash flow minus expected cash flow first we need to get, which is 8,000 minus 12,000, which is minus 4,000, 10,000 minus 12,000 minus 2,000, 12,000 minus 12,000, it is 0, 14,000 minus 12,000 is 2,000, and this is 4,000. Okay, then we just take the square and multiply it with probability. So 4,000 square multiplied by 0.1. 4,000 square multiplied by 0.1. That's going to be what? 4,000 square into 0.1, which is 16 lakh. Okay. And this is what? 8 lakh? Or sorry, 8 lakh, yeah. Then, of course, this is 0. Then this is 2,000 into 2,000 square into 0.2. So that is 2,000, yeah, 8 lakh. And finally, we have this as 16 lakh. Total of all of them is 16 plus 16, 32 plus another 16, so 48 lakhs. So probability into the deviation square, that's 48 lakh. So you can say variance of cash flow. Variance of cash flow is 48 lakhs. What can we say about the standard deviation? The standard deviation of cash flows is going to be square root of 48 lakhs. So what's the square root of 48 lakhs? Square root of 48 lakhs. How much is it? 48 lakhs square root. That's 2,190.89. And then we have coefficient of variation. Coefficient of variation is standard deviation divided by expected cash flow. Standard deviation is 2,190.89 divided by expected cash flow is 12,000. 2,190 divided by 12,000. This is 18.25%. So coefficient of variation is 18.25%. Okay, that's for project A. Now we can do it similarly for project B also. So you can obviously try it later at home. And just giving the answer that project B is going to have certain parameters. So let me just provide with the parameters of project B. Project B is going to have, I'm just providing the answer. You can later on check with it. So project B is going to have an expected cash flow of 16,000. Standard deviation will be 4,195. Okay. These are the two numbers which you can verify later on at home by practicing the question. Okay. So that is about this question number 5, guys. Okay. There is another case, when we want to compute the expected cash flow and NPV thing. For that, we'll look at question number 13, guys. It's a very interesting case over here. So this is also like a project which is having 3 years of cash flows. But here the variation is there in the cash flow in each of the years. And we have to calculate the expected NPV. Of course, expected NPV will be the present value of the expected cash flows. But the problem here comes when we want to compute the standard deviation. So let's try to sort this out. So for question 13, for each of the years, year 1, year 2, and year 3, we have the probability and then cash flow after tax. So we simply do it as probability into cash flow. Okay. So probability into cash flow. Okay. So year 1, probability into cash flow after tax. So that's probability into cash flow. In fact, let's calculate the standard deviation and variance for each of these years. So we have probability into cash flow. Then what we do is we simply take cash flow minus expected cash flow, and then probability into cash flow minus expected cash flow square. So probability into cash flow minus expected cash flow square. So okay, for year 1, we have this as 0.1, 0.2, 0.4, 0.3. The cash flows are 14 lakh, or let me just write it normal number, just write it as 14. In lakhs, you can just definitely say. So 14, 18, 25, 40. So you just first multiply probability with the cash flow. So that's 14 into 0.1, which is 1.4. Then this is 3.6. This is 10. And then 0.3 into 40. It is what? 12. Right? So total of this, we know it is the expected cash flow. Expected cash flow is what? 10 plus 12, which is 22 plus 27. Okay. And then we take cash flow minus expected cash flow, the deviation, right? So let us talk of the deviation numbers, and then we take the square of it. So deviation numbers are 14 minus 27 minus 13. Then you have this as minus 9, minus 2, and 13. So let's take a square of it multiplied with 0.1. 13 square is what? 169. 169 into 0.1, that is 16.9. 9 square into 0.2. 9 square is what? 81. 81 into 0.2 is 16.2. Minus 2 square for that, that's 1.6. 13 square is again 169 into 0.3. 169, that's 50.7. Total of this 51, 32, this is what 85.4. Okay, so we have the variance, and then we have the standard deviation of year 1. Standard deviation of year 1 will be square root of 85.4, which is 9.24. Okay, so this is what we have got, the expected value of year 1. Same way, I'll just give you some time to compute the expected value and standard deviation of year 2 and year 3. So calculate the standard deviation and the expected value of year 2 as well as year 3 is. Because after that, we are going to do something really interesting. Yeah. Give me the expected value and NPV for these years. What are the numbers? So when it comes to year T, second year, so in year 2, going to have a similar calculation. Okay, but then numbers are different. So for year 2, the cash flows are definitely different numbers. Year 2, the cash flows are with the probability of 0.1, 0.3, 0.4, 0.2. Cash flows are 15 lakh, 20 lakh, 32 lakhs, and 45 lakhs. So just multiply with probability and then you carry out the entire stuff. And what we get as the expected value is 29.3. And the variance term, which is summation of this, is going to be 98.61. Standard deviation will be 98.61 square root, which is 9.93. So this is standard deviation for year 2. Same way, standard deviation for year 3. Standard deviation for year 3. One second, it is some different. No, this was belonging to the first year. This is 98.61 and 98.61, 9.93. Yes. Then for year 3, the expected value, year 3, expected value in year 3, you should be getting it as 27.9, and the standard deviation numbers of year 3 is 8.62. Okay. So now we have data for all the 3 years. So we have year, the expected value, and standard deviation. So we have year 1, 2, and 3. So in the first year, we had the expected value as 27. Then we had 29.3, and then this is 27.9. Standard deviation is 9.93 in the second year. First year, it was 9.24. 9.24, 9.93, and 8.62. Okay. These are the numbers that we have now. Okay. Now, the company wishes to take into consider all possible risk factors to airline operations. Expected NPV of this venture, assuming independent probability distribution with 6% as risk-free rate. The possible deviation in the expected value, and how would the standard deviation of the present value distribution help in capital budgeting decision. Okay. So we want to get the expected NPV considering the independent situation. So whenever we look at expected NPV, we can definitely take the present value of all these cash flows, right? So expected NPV, as far as expected NPV is concerned, we can get the present value of each one of them. So we'll say year 1, 2, 3 cash flow. I'm taking the expected cash flows. So we're going to take the expected cash flows. So expected cash flows are what? 27, 29.3, 27.9. We take the present value factor and then take the PV. The present value factor, or the rate at which we are going to discount, is 6%. So I need to discount it the PV factors needs to be discounted at 6%. So PV factor is what? 0.943. Then we have 0.890. Then we have 0.840. Just multiply the expected cash flow with PV. That gives you 24.97 as the expected NPV. Okay. So this is your expected NPV, 24.97. Fine. That is done. But when it comes to variance, how do we get the variance now, guys? Remember, variance of NPV. Variance of NPV will be variance of cash flow in first year. Obviously, we discount it by 1 plus R. You will add to it variance of cash flow in year 2 divided by 1 plus R square plus variance of cash flow of year 3 divided by 1 plus R raised to 3. But wait, since it is a variance term, numerator is a variance term which is a squared term. So numerator being a variance term which is a squared term, I need to even square the denominator. So in the denominator, we are going to take a square. So this essentially becomes variance of cash flow, which is first year cash flow. Variance of cash flow is what? 85.4. So this is 85.4 divided by 1.06 square plus second year variance. Second year variance is 98.61. 98.61 upon 1.06 raised to 4 plus the third year variance. Third year variance will be expected cash flow of year 3. I mean, variance of cash flow of year 3. Variance of cash flow of year 3 is 74 point. Yeah, 74.29. And then we divide it by 1.06 raised to 6. So when we solve this, we'll get a variance of NPV. So if you're solving this, the variance of NPV will come out to be 206.49. That's the variance of NPV. Now, of course, without saying, we can say standard deviation of NPV. So standard deviation of NPV will be 206.49. Just take a square root of it. Okay. So square root is 14.37. Right. So 14.37. That's the standard deviation of NPV. So remember, whenever we have these type of situations where the cash flows are provided for 3 years and the cash flows are subject to variations, then you calculate the variance for each one of the years. Okay, simply calculate the variance of each one of the years, and then what you do is simply take the variance of NPV by adding variance of cash flow of first year divided by 1 plus R square, then 1 plus R square the whole square, 1 plus R cube the whole square. So every time it's going to get squared. And then take a square root of it to arrive at the standard deviation. Okay. Okay, fine. So with that, we have completed this risk analysis part as far as the probability is concerned. We have numerous other techniques of capital budgeting also, which will be obviously taking up in the upcoming sessions. So right now, if you guys have any queries, you can just highlight it. We'll discuss that, and then we'll be calling it a day. Any queries, guys? Any queries? No queries, everyone?
I think, and there are no query
There are no
from
queries.
student side.
Hmm.
Okay, thank you, Jagbandu sir. Because you have started the session with a very basic, you have developed a, or I can say that you have explained the overall framework of this chapter. That is, what are the various topics are involved in the advanced capital budgeting decision, and you have given more insistence on the concept of adjusted present value method. That is one of the very important method. So student, this is a this topic is a basically a version, advanced version of the topic that you have studied at your intermediate level. So here we can say it is a practical applications is there, because in the at the intermediate level, generally we assume that the all cash flows are sure. Okay, Shailendra, Gautamji, I explain you how for how many number exams are expected. I will explain, don't worry. So basically, in intermediate level, at intermediate level, the generally we assume that the all cash flows are sure, and that we can say they are with a surety. Certain cash flows are certain with a certainty, but here element of probability always exists. So here we have started our chapter with the including this or embedding this concept in our cash flows. And so far as the number of allocation of marks to this topic is concerned, generally it may be depend. It may be 4 marks, 6 marks, minimum 6 marks are there. They can be in the form of case scenario as well, or up to maximum 10 to 12. Even this type of questions can be asked. Normally, from the past experience, we have seen that somewhat the whenever any question, descriptive question comes, it generally carries a long weightage of more weightage of marks like 8 to 12. Otherwise, in a case scenario, it can vary from 4 to 6, or even 8 or even 10 also. So this is a topic, and next time, sir will continue this topic. So meanwhile, you revise the same, and if you have any query, so you can write to us. Jagbandu sir, just share our number. It is our contact number 01203045 956. 0120 our STD code, and our email ID is sfm-final@icai.in. Okay, student. So please keep revising the same. And if you have any query, even you can ask Jagbantu sir before he starts the new topic, or you can even send us the mail, or you contact us. Thank you very much for the patient listening. Thank you, and have
Thank
a
you.
nice day. Thank you, Jagbantu sir.
Thank you, sir. I'm obliged.
Thank you. Have a nice day, sir. Yes, you can end the session.